Good morning, afternoon, or evening to everybody who has joined or who is currently in the process of joining. Welcome to ARK Big Ideas 2025. This is our first ever Big Ideas webinar that we're hosting out of Europe, and we've got a fantastic lineup for you all today. Let me kick off this by throwing out an interesting stat. So our Big Ideas report this year has been downloaded and viewed over 60,000 times. And that's just in the first 3 weeks since our publishing of the report. And as a reference, this is more downloads than the total number of downloads we've received altogether last year. So we're living during the best of times. I'd like to believe these numbers also tell us something, which is that the appetite for learning about and understanding true innovation has never been greater. And people, including, I imagine, all of you who are dialed in today, want to understand where the world is heading because we appear to be heading there rather quickly. So I'm confident that you all are going to join, everybody who's joined today will walk away with at least, a couple of takeaways. Hopefully one that is, mind-blowing and paradigm shifting, perhaps that will make you rethink your future. Of course, no pressure. But before we dive in, I want to quickly cover off a few things. So number one, on this slide here that you see on the map, we are a global asset management heavyweight today. We manage in excess of $25 billion in AUM, while we've had teams in the US, Asia, and Japan and beyond for a long period of time. With the launch of ARK Invest Europe, our reach is now expanding further. And I was actually just told before we started this webinar that we have 121 countries represented on this call, which is our highest ever. I don't think we've ever had, at least in Europe, over 50. So this is a pretty impressive number. So thank you everybody who's joining once again. And so number two, and therefore, we're going to be offering instant translated subtitles today as well. So as we do have people from all over the world, so to enable these, click CC or live transcript. That should be a button on your Zoom toolbar, and select show subtitles. And if you need to change the language, click the small arrow next to CC/live transcript, and you go to subtitle settings, and you can there select your preferred language. If you need any help, always feel free to drop us a line in the chat box. So with that out of the way, for today's sessions, we've got an incredible lineup for you. Joining us are Cathie Wood, founder, CEO, and CIO of ARK Invest. And we've got for you Brett Winton, Chief Futurist of ARK Invest, who leads our research efforts. And then Thomas and myself, based in Europe, who will moderate the discussion. So with that, I'm going to hand it over to Brett to kick us off with a great analogy about exponential impact.
Sure. So at a very high level, I think you should think about this current state of the world as we're entering a great acceleration. And there's this parable about compounding where the Indian ruler's advisor who invented chess, the ruler was so pleased with chess, he turned to the advisor and said, what can I pay you? I'll pay you anything. And the advisor says, oh, I don't require much, Your Highness, just a single grain of wheat on the first square of the chessboard, and then double it on every square thereafter consecutively. And the ruler thinks he's getting off great. He's like, oh, this is cheap. And he goes bankrupt by the sixth row of the chessboard. And he's only paid 0.001% of the final bill. And so the analogy to today that's interesting is that there are 64 squares in the chessboard. The integrated circuit was actually invented and introduced roughly 64 doublings ago, in terms of, 32 doublings ago. So if you consider it from a Moore's law perspective of a doubling in computer performance for every 2 years. And if actually you track through the data, we are now in the sixth row of the chessboard as of 2023. So if you can go to the next slide, you can see an illustration of this where every one of these dots represents a performance doubling per dollar spent of compute. And the And the unit on the x-axis is actually number of Colossus-sized data centers that we've built cumulatively over the course of human history. The Colossus data center is XAI's data center in Tennessee, and we did this chart before they announced that they had doubled it in size. And so what you can see is that by the purple line that diverges above is the acceleration and compute capability per dollar spent that we're getting from artificial intelligence. So it's pulling performance doublings more closely together, even on the same amount of money spent. And it's causing us, we think, over the latter half of this decade to get to the end of the chessboard. So 64 performance doubling since the introduction of the integrated circuit. It means essentially the squares on the chessboard are getting closer together. And that's why everybody can feel kind of like this, oh my gosh, things are happening so quickly. It's because they are. The cost decline in AI is a performance doubling every 4 to 5 months. We think that's going to continue prospectively. In traditional technology space, cost declines, performance doublings happen every 2 years. And so a company that is what in traditional technology would have been 1 year behind is 5 years behind today, equivalently. And this has real world impact if you go to the next slide. So this is not just in technology land, but this acceleration in AI is what is going to lead to, in our view, Tesla's was full self-driving, being safer than human drivers by the second half of this year. Tesla's likely to commercial launch in June. They can do so even before you're safer than human drivers because you can have an operator that intervenes in case the car is confused. That's how Waymo does it. But to go from a critical intervention every 1,000 miles to a critical intervention every 700 or so thousand miles over the course of a single calendar year gives you an indication of how kind of this acceleration in AI actually leads to a real world tangible change in the way people are going to live and the change in the way businesses are going to generate cash flow. In the middle, drug discovery, we think is going to become markedly more efficient. Year over year, the number of hypotheses that a researcher in the company Recursion Therapeutics could test has approximately 5x'd because they are powering their drug discovery with an AI engine underneath. And it transforms direct technology capability. So on the right is if you assign a state-of-the-art AI system to write software for you, what percentage of problems will it solve on a software engineering benchmark without any intervention from you? That's gone from 4% in 2023 to now almost 3/4 on ChatGPT's state-of-the-art model. It can solve. And so we're going to have an abundance of software stitching the world together as a result of this acceleration. Okay, next slide. So what's interesting about artificial intelligence is, and the acceleration in artificial intelligence is it impacts and pulls forward every technology category that we focus on. At ARK Invest, we think there are 5 major innovation platforms that are going to transform business in the world over the course of this business cycle. AI is the central dynamo, and it's driving forward multiomics, which is in green on this, public blockchain, which is in yellow, energy storage, which is in gray, and then robotics, which is in red. And so an acceleration in AI actually pulls forward our forecasts for these other technologies. So the fact that it's moving so quickly means the entire innovation space is likely to deliver more transformative outcomes over the course of this decade. Next slide. Not only does this have kind of like, hey, technology is accelerating, it's going to have real transformational macroeconomic impact. And so we think that over the course of the latter half of this decade, macroeconomic growth is going to average more than 7% real compounded. And that sounds like, how can that be? We always grow at 3 or less percent. But if you look at the course of economic history has been peppered by major changes in the innovation landscape that lead to structural changes in the rate of macroeconomic growth. So this captures a long macroeconomic history all the way back to the year 100,000 BC. If you lived in the year 100,000 BC, the prospects of your life improving were not great. I mean, basically there was zero growth, or 0.037% compounded annually over 100,000 years. And then with the introduction of writing and the ability to administer, empires effectively, the rate of growth jumped. And then in the year 1000, we actually got a lot better at agriculture and were able to densify populations in cities that was efficient. And that, again, doubled the rate of annual macroeconomic growth into the Enlightenment, and kind of all the innovations that came out of that doubled it again into the second industrial revolution in the early 1900s, the introduction of electrification and the telephone and the automobile, which led to kind of like the current state of kind of modern economy all the way through computing. And we think we are entering a new kind of economic era on the back of these 5 innovation platforms. And this forecast is consistent both with this long macroeconomic history and our expectations for the underlying technologies and the way that they're going to change the world. We think that robotaxis are going to be the most productivity delivering innovation since, or even surpassing the steam engine in terms of their pace of productivity injecting per year into the macro economy. And you can justify this forecast just based upon mostly our expectations for robotaxis and robotics. Leave aside multiomics, which is going to extend people's lives, AI and all of the software that it's going to generate, and public blockchains in the way that they're going to allow capital to be more efficiently motivated into the opportunities that make the most sense for the world. So it's really going to be an interesting and exciting decade. And I hope this gives you a flavor of why we think so. And now we're going to go into the individual technologies so you can understand, how we come to these conclusions. Cathie.
Yeah, I will actually introduce Cathie and the research that we've put together within our agentic AI section. And Brett, I think you set the stage perfectly for this topic, which is, I would say, arguably the world's most prominent topic, which is artificial intelligence. And within this section, Cathie, as you know, the team's put together research on monetization, adoption, cost declines, which has been obviously very important to watch, especially this year in terms of the new data that's coming out, the shift within the tech stack to software and specifically to AI platforms, as well as the overall productivity uplift that we've seen and that we expect to see within artificial intelligence. So without further ado, Cathie, why don't I pass it to you to hit on this very important topic?
Sure. Okay, we'll start with AI agents. So all of us know what AI agents are because we use ChatGPT. Of course, that's a siloed single purpose agent in many ways, but we are beginning to learn that it is becoming smarter and smarter. So large language models are becoming much more sophisticated and enabling higher value tasks. So wouldn't I have loved, when I started ARK 15 years ago, to have had an AI agent alongside me to help me develop the business, develop a marketing plan. That is what is happening now. And it's very exciting. It's also lowering the barriers to entry in terms of innovation. So I think we're going to get a lot more of it as AI costs continue to drop. AI training costs are dropping 75% per year. AI inference costs 85, maybe 95% if you believe DeepSeek per year. And so the cost of innovation is beginning to collapse, which is very exciting. So if we go to the next page, so it's accelerating the adoption of hardware and software. I didn't explain on the previous page, of course, we understand a personal AI agent can help me with my shopping anywhere in the world at any time, best price, lowest cost delivery. So it's both personal and business. So very big idea, obviously. Here you can see how quickly OpenAI has gained traction in the purple line on the left there. This year, we think it's going to generate almost $11 billion in revenue. And that's because, well, we know about the $20 to $25 per person, personal use. But there are higher level use cases now that are going for $200 a month. And as OpenAI actually starts making engineers so much more productive than they are now, we could see it going to 10 times that amount. And you can also see on the consumer side how quickly AI hardware has taken hold. It looks very much like the smartphone adoption. Again, great convenience, obvious use case, and an explosion in demand. On the next page, you can see what we expect for the economics associated with AI agents. On the left-hand side, you can see what we believe is going to happen as the percent of consumer interactions handled by AI take off. We all have experiences of being left on hold as automated chatbots, so they were called, are trying to help us, but the quality has been atrocious. We all have had experiences of just giving up. You can see here, if we're right, and we do believe this is playing out already, that that we're going to save a tremendous amount in terms of human labor costs that will give way to AI software costs. So it's a win-win, and you can see the savings in green there. It's a win-win because it's better quality service, and we will probably lose the call centers. In fact, the labor decline in call centers has started to actually implode over the last year. So this is happening very quickly. You can see on the right-hand side, if we were to assume that the dollar cost per conversation were to drop from $1, let's say today, down to 12.5 cents, which I just gave you some of the stats associated with the cost AI cost declines. We could see the demand for customer service increase by 8-fold because it will be so much better than what we have now, and deliver enterprise customer service savings of $540 billion. So there are a lot of win-wins in here. On the next page, you can see that AI, and Brett got to this in his section a bit, so I won't go too much through it, but it is amazing that in really little more than 1 year's time, this coding agent was able to complete a coding task from beginning, just prompt it with a text. This is what I want to do. And this is where I want to go. This is what I want the result to be. In late 23, I remember we were studying it, and I was thinking at the time, wow, that's not too good. It was basically 4% completion rate, successful completion rate. Now it's more than 70%, or at least in the fourth quarter of last year. And, the innovation in this space is coming at us so quickly, with Grok 3 delivering even more surprises than and much quicker than I think most people expected. So I am sure the next time we draw this chart, it will be well above that low 70% range. And in the process, and we get a lot of questions about this, Thomas mentioned it in the beginning, you can see that we expect on the right-hand side, enterprise software spending growth actually to accelerate at the infrastructure level, the platform level, and the application level during the next 5 years relative to the last 5 years. But on the bottom part of that chart, you'll see that we expect the platform layer to take share over time. It already is. And I think that's one reason why a company like Palantir has just taken off in a way that most people wouldn't expect. And many cannot understand the valuation at which it's selling right now, but they also haven't understood and probably still don't expect the rate of growth, the magnitude of growth ahead that that will grow into that valuation. The other thing I'll say here is software as a service. Why is it going to lose share? And here, of course, all of these numbers will be adjusted with time because this is a very fast-moving space. But if we can move away from software as a service, one size fits all, to bringing in-house to our much more productive engineers the task and customizing it to our own companies, well, that is a winning solution. So we're pretty excited about that. And even we have done, and we're a very small company in the context relative certainly to the Department of Defense, where Palantir has, where it cut its teeth. But we've done a pilot test and we can see already the ways in which it can impact our business and other businesses dramatically. And here you can see this is supercharging knowledge work. I know that a number of the charts are talking about how little we will need some kinds of knowledge workers. That said, you'll see on this chart, even with rapid mass adoption of AI and significant investments, we expect the knowledge worker world to grow, and we expect the value associated with each job to increase as each person becomes much more productive. So you can see on the bottom there, I'll just wrap, knowing we have a lot more slides to go through. Once again, the growth rates we associate with the overall software market. You can see knowledge work or labor costs in aggregate going down, and the share going towards software in the purple line there. So massive shifts. I'm not even going to say once in a generation. This is once in 5 generations. With the last time we saw this massive amount of change was, as Brett said, in the early 1900s, when we had 3 innovation platforms evolving at the same time. Now we have 5: robotics, energy storage, artificial intelligence, blockchain technology, and multiomic sequencing.
Fantastic. And wow, Cathie, it's so basically we're going to be swimming in software. And I always recall that scene, you know, from Minority Report, where Tom Cruise is managing all these AI agents, if you will. And so you've got, everybody becomes a CEO, and you've got an infinite number of employees working for you at all times. So thank you for that brilliant analysis, Cathie. Staying on the theme of disruption, but shifting our focus. But I would say in this case, you know, perhaps less of a shift, but more of a convergence. While AI and robotics are often thought of as 2 distinct and separate categories, a lot of the work we do indicates that these 2 things are rapidly coming together. They're integrating, and so that's also very much reflected in how we think about investing in AI and robotics. If you followed that thread, separating the 2 today might actually be a false dichotomy, we think, and so prime examples would be autonomous vehicles and humanoid robots. So the world of bits is converging, it seems, with the world of atoms. And so for this section, I'm going to hand it over to you, Brett. The floor is yours.
Sure. Of all of the kind of technologies that we follow, the humanoid robots forecast is the one that has been shifted the most to the left by the acceleration in AI. A few years ago, our belief was that humanoid robots would be both mechanically and software constrained. As it turns out, and as you can tell from the demo videos that you've seen, actually, if you devote resources to manufacturing that specific form factor, you can create really performant humanoid robots. And so then an acceleration in software should lead directly into their capability. Figures Helix announcement where they're doing end-to-end AI to drive robots to be able to do tasks that they've never seen before, pick up objects that they've never seen before without a lot of training, is indicative of the direction the entire space is going. Here we lay out what the potential market size is, and this is really why so many people are excited by this space from an investor perspective. On the household side, we think you have $13 trillion in potential annual spend in terms of total addressable market. And so you could imagine that could actually translate into a larger volume of robot sales to basically 13 trillion is if households all wanted to rent one, that's what they would pay. And it's based on the fact that, people do, 2 hours of labor and like folding clothes and doing dishes and stuff a day. And if you look at time use studies, people are generally willing to pay half their wage rate to displace that with a technology. This is really analogous to what's happened in the past when the washing machine became available. That was a huge GDP productive event because people no longer had to hand wash clothes, which wasn't captured by GDP. Instead, they bought a washing machine, which was captured by GDP and paid for the electricity to run it and the maintenance and service workers to come in and service it. And then they freed up their time to, actually, in that case, enter the workforce and do other productive work. And so with the robotic space and autonomous mobility, it shares that common characteristic where you're taking non-market labor and you're turning it into something that's going to be captured by the market to free your wonderful human brain up to do other wonderful human brain things, with the robot doing the drudgery of folding clothes. So I'm a very good clothes folder. And then we think there's an equally large opportunity on the manufacturing side, roughly equal to the household side, just on the basis of if a robot can be supervised by one human and do as much as that human. And then kind of the robot company gets a take rate off of the productivity they deliver into the manufacturing sector. That's highlighted in the green on the lower right. That's also a $13 trillion opportunity. So across the two, we think that there's a 20 plus approaching $30 trillion opportunity in humanoid robots. And this was, as of a few years ago, we thought this was going to be a early 2030s type event, but it's increasingly clear that these companies are going to sell in and begin to commercialize over the latter half of this decade. And so if you go to the next slide, I'm not sure. Yeah. And what's one of the interesting things that's going to happen here is this will allow small manufacturers to actually get much more productive than large manufacturers. If you think about a small manufacturer, the person that opens the mail is the same person that's trying to pack items into boxes, and he might have a job actually hammering in some nails into something, or doing the final polish on a device that they're making. And so it's detailed in the math here, but the way it works out is small manufacturers end up paying lower wages, and then they have less incentive to automate tasks because each worker has a bundle of different tasks. And so a specific automation solution doesn't work. Well, with a humanoid robot that can generally do stuff, it can empty the trash and open the mail and pack the boxes. Actually, that provides a bigger opportunity for smaller manufacturers rather than large. So people think about robots going into automotive factories, but actually a lot of the automotive work is specialized and scaled. And so specific robots have been developed for those specific tasks. Now, there's an opportunity in automotive, but there's a bigger opportunity if you look across the US economy in providing these general purpose tools to small businesses so that they can work right alongside the human workforce and kind of fill in where needed. And so it's an interesting, it actually changes the dynamics also of how these robots will be distributed. You don't pay like a very expensive sales force to try to sell into all these mom and pop manufacturers. Instead, it has to be more like Tesla sells cars, where it's like you go to a website and you order one and it arrives and you unpack it and you'd be like, okay, go do some work. And so it changes kind of like the industry dynamic behind automation systems in an interesting way, and could result in a more aggressive adoption curve once these things are available. Next slide. Now, people always ask, well, okay, so we're going to have all these robots. Clearly, everybody's going to lose their jobs. But, you know, history suggests otherwise. If you look at the introduction of the tractor into farm labor and all of the wonderful automation tools we have for farm labor, 80% of the people who quote unquote lost their jobs weren't getting paid. They were just working for sweat equity as kind of family members of the farm. And so, you know, again, I think there's a lot of, Cathie's about to talk about autonomous robotaxis, but there's a lot of work that people do that's not like work we get paid for, but is work that we're absolutely having to do. You know, and so, or it's work that just goes undone. So having something that can go around and clean up a factory and like pick things off the floor and put them in trash cans and take those trash cans out on a very, very regular basis probably results in a better working environment for people. And it probably like reduces injury risk in some way, and in a way that's hard to quantify, but would be net better for all of the employees in that firm. And so ultimately, we think we're going to enter a world where the physical production of things is going to become much more productive. And as a result, you're actually going to, you know, increase the number of people that are guiding these robots to do things, not decrease it. And we'll end up with like much more abundant production of all the stuff that we love to, you know, wear, drive around, and I don't know, brush our teeth with. Okay. Okay, so here's a very tangible and specific example. If you think about kind of of where you end up with macroeconomic savings effectively, or a macroeconomic productivity. Right now in the US, people spend basically $1 trillion of labor cost a year, you know, preparing food and doing the dishes. And so if you compare, like when you go to Chipotle, and well, Chipotle is actually kind of expensive for a fast casual meal, but when you go to fast casual, it's maybe a $12 meal. And if you're cooking at home, it's cheaper on a food basis, but when you layer in the labor cost, roughly the same, a little less. And so net, we actually spend more money on food at home once you accommodate that labor cost. And so I know some people enjoy cooking, and I also occasionally enjoy cooking, but I usually would prefer to have somebody prepare meals for me. And so if you have a robot that can do the first, at least the cleanup, and then also the food prep, and can kind of like at least carve out some of that labor cost, that's $1 trillion savings to consumers to devote to other time, you know, and so it also could shift kind of the dynamics of food delivery versus kind of like at home, you know, grocery ordering. So that's an example, but there are many that we could go through of how kind of, you know, the humanoid robot dog sitter, I think, is a great penetration thing because it keeps track of the dog. It can walk it during the day, and then it'll do other stuff when it's not petting the dog. And that's what's interesting about this technology is you can buy it in because it's good for a specific thing, and people can underwrite it because it can do just, you know, an hour worth of work for them. And then it'll become more capable over time because of the acceleration in AI.
Well, thank you, Brett. As a parent of 3, I'm very thankful for the washing machine and very excited about the future of humanoid, and equally so full self-driving. You know, the thought of any teenager behind the wheel scares me a little bit, and I'm sure we all feel the same way. And I'll use that as a segue to get into Robotaxi, because like you mentioned at the beginning of the call, we are inching closer to a commercial launch by Tesla. And obviously it's very exciting to look at the data that comes out from a cost decline perspective, making this technology more achievable. And from an efficacy perspective in terms of looking at safety data. So Cathie, I'll pass it to you for the latest and greatest within this space.
Yes, well, I have 3 children as well, and I do remember the days when there was no prospect of autonomous, and between play dates and sports and birthday parties, I mean, the weekends were exhausting. So autonomous it has always been intriguing to me, knowing the alternatives all too well. Okay, so you can see here, Tasha Keeney has done this analysis, very well known for it as well. You can see the cost per mile of different forms of travel. So human-driven ride hail. So think Uber. Says $2 here. You know, in some cities in the US, it's not $2. It's $3 or $4. It's gotten crazy. Personal car is $1.10. That includes depreciation, insurance, all in per mile. Human-driven ride hail in China today is 35 cents, and we expect in 2035 25 cents for global robotaxis. Now, it's interesting. Many people ask us, you know, where is this going to take off geographically? You can see the need is much more in the developed world where labor costs are so high. And as Thomas mentioned, we have commercialized here in the US and in places in China, Waymo, and we'll get into that in a moment. Actually, no, we'll get into it right now. If anyone has had any experience with Waymo, a Waymo ride in San Francisco, Los Angeles, there are a number of places in the United States. People come away marveling. Now they're geo-fenced and they are not safer than human-driven, which I'll get to in a minute. And so we've been wondering, okay, does Waymo / Alphabet have this market? This slide would say no. As you can see, the cost of a Waymo 6th generation at scale, that's the third bar there. You can see that depreciation is still very high, right? And you can see it versus the 5th generation and the Model 3. You can see what Cybercab is going to be, and you know, the lower cost because it's vertically integrated, not dependent on other auto manufacturers, and because it's streamlined the technology and voted against LiDAR almost from the get-go, has taken the capital cost down significantly to relative to where we believe Waymo will be. So you can see here that for every $5 billion on the right-hand side, $5 billion in CapEx, Waymo / Hyundai would be able to produce a little less than 100,000 vehicles, whereas the cybercabs, Tesla could produce more than 300,000. So 3 to 4 times as many. And so low cost of production is going to be key to success in this winner take most market. And we do believe it is winner take most, as many AI projects are. We think this is the AI project out there with the biggest revenue generating potential in the next 5 years, $8 to $10 trillion globally, everywhere, all parts of the ecosystem, with the platforms like Tesla getting half of that. And I know later on we'll go towards what we believe is the most profound application of AI. But before I do that, this is where we are in terms of autonomous relative to human performance. And you can see how quickly, again, this is AI, how quickly things are changing. You can see that by this month, roughly, and these expectations, I think, are still in place, that Tesla will is going to have a critical incident or critical intervention every 10,000 miles, which is 16,000 kilometers for those of you on that system around the world, which is, at least in the US, 1 year's worth of driving. But by the end of this year, that number will go to 700,000, or a little past 700,000, which is the national average human accident rate in the US. So safer than human driving. You can see that Waymo has done very well at 400,000 miles per intervention, and kudos to it. It's gone a long way. But by the end of this year, we think Tesla will outperform Waymo pretty significantly. And then finally, this is going to create, as I mentioned, the $10 trillion market. And you can see it will happen, as always, as costs come down. You know, the history of technology is studying those learning curves, which are expressed in cost declines, which are passed through to price declines, which expand markets enormously. And that is what we expect from this market.
Fantastic. So we're about 2/3 of the way through this webinar, and so far we've covered some incredible advancements. Now, if we can navigate city streets without crashing into pedestrians, imagine what we can do when tackling something more complex like the human body. Turns out AI isn't just revolutionizing the way we move, but also how our bodies, our understanding of our bodies. So at ARK, we've built I'd call it a thematic framework for the future of medicine, and it's our multiomics flywheel. No other firm is thinking about and investing in the multiomics revolution in this way, as far as we've seen. And we believe it provides a completely new lens into how AI-driven innovation has the potential to transform healthcare. And so to dive deeper into what this means, I'm going to hand it back to you, Cathie.
Sure. And so I mentioned before, the largest revenue generator near term, next 5 years, is autonomous mobility, we believe. But the most profound application of AI is in the healthcare space, multiomics. And by that, I mean, we are already curing disease, but now we're going to have, and you can see on this page, you can see what AI is doing to speed up the performance or the rate of change in the multiomic space. You know, the key to AI is data, proprietary data. There is no other space that generates more data than the multiomic space. We have 35 to 40 trillion cells in our bodies, and now we're moving to single cell sequencing, which is astonishing. And the only way we can do this is with different sequencing technologies combined with AI. And so you can see the kinds of advances and the companies associated with these advances in multiomic tools. So 100-fold decrease in the cost to read DNA by 2030. And we've already seen massive declines. You can see AI developed drugs. It will cost 4 times less to develop a drug in 2030 than it does today. And we believe the returns on R&D are going to go up dramatically, and Brett will focus on that. Molecular diagnostic testing. Diagnosing cancer in or before stage 1 is critical, and with AI, we will be able to do that. We believe already in some cases we are, and then cures, the holy grail. We're already seeing cures for sickle cell disease and beta thalassemia, thanks to CRISPR therapeutics. but huge number of trials in the pipeline. And it's all thanks to AI at the center of all of this. By 2030, 100 times more performant at the same cost. So 1,000 times, if I said 100, I apologize. So pretty exciting, pretty profound. And yet, I will tell you, one of the biggest, I think, obstacles to understanding what how profound this movement is the siloization of the traditional financial services world into sectors and industries and sub-industries. So the healthcare world and the technology world have never really gotten along. One is too highly regulated, bureaucratic, and slow moving for the other, and the other is not set up for breaking glass and moving fast. So, you know, we hope to be one of the reasons that that gap closes. You can see on the next page the productivity of genomic analysis, how it has skyrocketed. Now, this is analysis. When I first started talking about sequencing, the cost to sequence a whole human genome in the early 2000s was $2.7 billion. It was not at all scalable. Today, it's down to $200. The cost to analyze, that's what this chart is, one human genome back then was a half a year. Today, it's less than 10 minutes, fewer than 10 minutes. And so you can see for a $450,000 budget in 2001 to analyze a human genome, we can now analyze 1.4 billion human genomes for that same price. So again, shocking declines, shocking advances. We think the markets are a little lagged in understanding this, but on the next page, you can see why they will probably understand it more and more. Everyone has been touched by cancer, and it, you know, 25 years ago was much more of a death sentence than it is today. And in the future, even more, more so because of MRD, minimal residual disease testing. So this is right now, most patients are not covered for tests to see if the cancer is recurring. And with blood tests, we can figure this out 20 minutes before we see it in traditional imaging. We're going to see more demand pull for this. And so you can see what we believe the future total available market in terms of patient population is for MRD tests, 8.1 million versus 700,000 today. And you can see that the data generation, now the UK is known for having the biggest data biobank, very forward thinking. And you can see on the right-hand side how big it is. But look at what MRD testing is going to do to that data bank over the next 5 years, up 144-fold. So again, we hear about all of these data centers being built out. This is going to be one of the biggest use cases for them. And so now I'm going to turn it over to Brett to talk about, and he was instrumental in doing this work, about the ramifications for returns associated with drug development. Brett?
Sure. So what are we going to do with all that data? Well, actually, we're going to use it to inform how we develop and target drugs. This is a visualization of the left side is basically like status quo for developing drugs. Each little block is a stage in the drug development process. And the entire kind of block is how much money you're spending across an x-axis. That's the number of years it takes. And so you can see the industry isn't that good. Like it hasn't been a good investment. There's no doubt. You spend $2.4 billion to get a drug to market, including all of the cost of failures and the time cost of money. And as a result, you need to hit a very, very large endpoint population that's willing to pay a lot of money in order to get a return on that investment. So we think there's a series of AI-driven drug development efforts that are already in human clinical trial that have already demonstrated better throughput rates through phase 1, the toxicology testing, and seem to do better in phase 2 as well. What the result of that is you have your bars get smaller because you have less failures along the way, and they're able to cross these different phases more quickly. And so the time to market shrinks. So we think these AI drug development efforts that are right now in trial and in human trial and going to come to market are going to average around $1.5 billion per drug commercialized. And companies like Recursion and Absci that are setting up a process whereby kind of their data is feeding back into an autonomous lab that's continuing to generate more data and train their AI models is going to lead to even more efficiency. So there's a set of drugs that have not yet, that are just about to enter human clinical trial that we think are going to be able to get to market in 8 years on a total of $600 million in spend. So you can imagine, if you go to the next slide, like that transforms kind of your return profile, not just because you've spent less money up front, but because if you get to market sooner, then you have a longer patent life against which you can monetize that drug before competition can enter the market. And so if you shave 2 to 3 years off your drug development time, that increases the value of the underlying asset by 30 to 50%. If you shave 4 to 5 years, it increases the value of the asset by 70 to 80% because you get to monetize longer. And then on the right side is the cumulative cash flow of AI designed drugs versus traditional drugs, taking into account both the cost savings up front to get a drug to market and then that better revenue curve that you get if you can get to market sooner. And so you can see on a traditional drug development effort, you need 20 plus years before you hit cash flow break even, whereas it's roughly half of that for. And Thomas is, this is like having the Oscar person who like hooks you off the stage. Okay, so like so then there's another thing that's happening that Cathie alluded to, which is not only are we developing drugs more efficiently with AI, but a better understanding of biology and better tools, including gene editing, allow us to cure rather than just providing kind of like management of disease conditions. And so sickle cell disease has entered the market. To a man, and they're mostly men, but also to a woman, the sell side analysts we've talked to, where we ask them, are cures good for business? They say, cures are great for humanity, but bad for business, because you don't want to eliminate your addressable market by curing the people. You want to continue to give them drugs. They have it wrong. As it turns out, if you compare a cure even to a precision medicine that totally abates the disease, it is more than 2 times more valuable on a net present value basis, because a cure is priced based upon the lifetime value of cost that patient is going to have. And so you recognize that lifetime value up front, and for every patient that you administer a cure to, you avoid the competitive pressure you're going to have once your patent expires. The combination of those 2 things means that cures are actually a much more valuable cash flow generative proposition than we think Wall Street understands. And it's really interesting now because like the first real cures are entering the market and commercializing just this year. So people haven't actually seen the evidence of this, but we think that there's a number of drugs coming to market that people misunderstand the actual economics of, because they misunderstand the economics of the cure. And Thomas, if you want to usher me off the stage, I'll just have one last thing to say. If you combine the impact of these 2 phenomena, if you take AI developed drugs and cures, you can understand that it's going to change the return on R&D for the industry as a whole. The industry right now is printing a return on R&D of a little over 4%. That's not good. Like, you don't put equity money into something that generates you 4%. You need like 10% plus. Well, these first class of AI developed drugs, we think should deliver returns on the order of 14%. And then as they get even better and reduce fail rates north of 20, and as you get into cures that are driven by AI, you can get returns on R&D consistent more with traditional technology companies, all of the magical companies that we're aware of. So we think the whole industry is actually going to bifurcate into companies pursuing cures that are using smart AI design strategies to go after disease, and those that are still stuck on legacy R&D dollars following, pipelines that are 13 years long, where they're going to be surpassed by an AI developed drug halfway along, and all of that money is sunk cost. So it should be a fascinating latter half of the decade for biotech and drug development.
And I'm going to frustrate Thomas even more right now, because one thing that many people might be stuck on, as Brett showed the $1.1 million per cure, it is very interesting that the companies, CRISPR Therapeutics, is charging $2.2 million for sickle cell and beta thalassemia, and is getting that price. Insurance has had no problem with it in the US because it's saving so much cost in the way that Brett described. The Middle East is not, and even in the UK, which is the toughest, we don't, if there's a discount, it's minimal, just because there's a big supply constraint here. So they're getting that price, and they should. And one other thing, I was early in my career during the golden age of healthcare, which was in the 80s there. And you can see what happened after the Genentech glow faded, how badly the returns have suffered. Now there's real hope, but there are going to be winners and losers if they do not embrace these technologies aggressively.
Thank you, Cathie and Brett. I'm ushering both of you off stage with Oscar music, but the good news is you're about to win an award and go back on stage. But we know there's been a ton of questions that were sent prior to this webinar, as well as during the webinar. So I'm going to do my best to just aggregate some of the top questions. And I know we just have a few minutes left. So for both Brett and Cathie, if you could be relatively concise so we can get through a few of them. And the first, I'd say, is probably a very important question to ask. And that is, after everything you've discussed today, in terms of the advancements of technology, innovation, how can listeners, clients, investors invest in these innovations? How are you thinking about, for example, the Mag6 versus the rest of the market? Brett, I'll have you start this one.
Sure. So this is actually a visualization of our expectation for the aggregate market cap across the technologies that we dimension cast forward to 2030. And we think that 2/3 of equity market cap, roughly, including cryptocurrencies in there, so it's not exactly equity market cap, is going to be disruptive innovation exposed by 2030. And the Mag6, which everybody knows and loves, like over the last 5 years, there's been, or really 3 or 4 years, there's been this phenomenon where it's like, well, innovation is great, but actually, why should I invest outside of these 6 companies? Because they seem like they're going to rule the world. And I think for those companies in particular, their franchises are under threat by AI in a way that they probably haven't been since their inception. AI as a threat to Google search is more severe than probably back when they were battling Yahoo for share, and Microsoft was entering the market. And so this captures our expectation for the Mag6 is they're going to compound at 24%. This is our underwriting of those companies over 5 years forward, which is quite healthy. But we think that those companies are going to lose share to broader innovation. These innovations are truly disruptive. The companies that are most aggressively pointing after them and deploying them, we think are going to win. The likes of Coinbase and public blockchains, Tesla clearly in robots and autonomous mobility. We think Recursion and Absci in AI-driven drug development. All of the foundation models companies are interesting and potentially provide a disruptive vector against all of tech. So we think that there's going to be a real kind of emergence of a new class of companies here that aggressively deploy these technologies. And so my very high level takeaway is, most people have an unintentional innovation short in their portfolio. The most important thing here is we think that on a nominal basis, so not even real, that non-disruptive companies are going to shrink in terms of enterprise value over the 5 years forward, despite having an expectation that GDP is going to grow well ahead of kind of like traditional expectations. And the reason why is because those businesses are going to need kind of these technology tools to survive and thrive. And so kind of like disruptive technology, you know, if you own a traditional, you know, index, core index, you own, you know, freight rail lines. Well, EV autonomous trucks are going to price per ton mile competitive with freight rail. You own traditional cellular. Well, good luck competing against Starlink in terms of capturing marginal economics from customers. You know, you own traditional retail bank branches. Well, you know, they need to actually remake their infrastructure for digital wallets and public blockchains. So there's a lot of kind of very heavy fixed cost assets that have debt against them that we think could be imperiled by what's happening in technology. And so a healthy innovation and exposure is important just to like risk adjust your portfolio for the innovation short you have in the business you may own or the businesses you have exposure to through kind of like core exposures.
Well said. And I recognize, as you mentioned, blockchain. We've been light on blockchain in this presentation. So for everyone dialed in, please do download Big Ideas. 2025, we have 3 sections on digital assets, one of which is directly on Bitcoin. So Cathie, I'm going to ask 2 questions for you. The first is the latest views on Bitcoin and some of the research there. And then the final question, I'll just ask it ahead of time, will be the market outlook for 2025. I know we've seen lots of questions on some of the uncertainties, tariffs, and beyond. So if you could conclude with your views in that area, I think that'd be a good way to wrap up the webinar. But let's start with Bitcoin. And I did pull up one slide for you here.
Okay. All right. Yeah, and I also just to echo what Brett said, the share loss in terms of the Mag 6, big debates within the firm about how important distribution is versus technology disruption. So it's definitely a lively environment. So yes, Bitcoin. We have not changed our price target in quite some time, and you can see the building blocks associated with the price target. Our bull case has the probability of it, we believe, has increased as certainly with the new administration here in the U.S. Wanting to add Bitcoin to the Treasury Reserve. That's very interesting. We thought that would happen with emerging markets who are buffeted by the dollar left and right, that they would want more exposure to this appreciating asset. So we've been surprised that the developed world is really going to lead that move in terms of Treasury reserves. So Bitcoin, 3 revolutions in one. It's a monetary system. Bitcoin blockchain is a technology, and it is the first. It was the first. We wrote our paper on this in 2016. The first of its kind in a new asset class, and it's a very big idea. You can see the institutional, the purple there. Is the largest, it and digital gold practically tied, but relative to the base case, the institutional uptake is the reason the probability of the bull case has increased here. I think our new regulatory system critical to that as well. And then market outlook, we're obviously we're seeing a lot of volatility in the market. We're in a transition, and one of the things we think is going on and has been going on is we've been in a rolling recession ever since the massive interest rate hike, record-breaking hike, starting in 22, and in the U.S., most sectors are down and out. You'd think headline numbers say, "Oh, everything's fine." I think our election basically proved the opposite. And what's happening now is the last phase of that rolling recession probably is underway. Why? roughly 30% of employment in the US, 30% of the labor force is wondering, based on DOGE and how it's all going to fall out in the government sector, not just federal, but state and local, is trying to figure out, are they going to have jobs or not? And businesses are saying, wait a minute, are these tariffs going to mess with my supply chain? What should I invest in this new project when I really don't know? So I think what you're seeing right now, a lot of uncertainty, which is pushing down the velocity of money. The first decline in the velocity of money sequentially was in the fourth quarter. We think it will continue. We think you're going to hear more talk about a recession. And we'll just be concluding with, yeah, this is the end of the rolling recession, and the market should start to look through it because every other sector is down and out except for the consumer sector. So, bit of a pause there, and then the other side of that is the response to incredibly business-friendly policies. So we think animal spirits are going to take off. And as I mentioned before, the cost of innovation is collapsing. So we think entrepreneurial zeal is going to have a heyday. So we're pretty excited about that outlook. And our confidence in it is growing. What's interesting short term is many people are saying interest rates higher for longer, higher for longer. As you can see, the long rate is starting to go down. It's telegraphing something.
Well, thank you, Cathie. Thank you, Brett. With that, we conclude the webinar, but we want to thank the audience for staying with us for these 66 minutes now, so a few extra minutes. We really appreciate it. We clearly moved through the slides with alacrity, lots to cover, both depth and breadth. So thank you again for everyone attending. And we will release a number of recordings and videos specifically dedicated to different sections of big ideas. So our research team will dive a little bit deeper into this research. And that should be released hopefully in the next couple of weeks or so. So be on the lookout for that. And again, we thank everyone for your time, and hopefully today was quite insightful.